Every now and then we get a buzzword that media will talk about for maybe 2 weeks or so. NFTs, Bitcoin, yield and interest rate, Cathie Wood, Tesla, meme stocks, and I can keep going. Point being, these terms get their screen time. These days, inflation is in vogue. Let's talk about what it means for our money, and do you really need to worry about this, or is it mostly noise? Hey guys, welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, and apparently inflation. If you spend 10 minutes watching CNBC, someone will bring up inflation. So, in this video, let's talk about what is inflation and how it impacts our money. Inflation equals higher prices for everything around us. Another way to put it is when inflation is on a rise, a $5 burger may cost you $6. Inflation reduces your purchasing power or value of money. Some level of inflation is considered normal, around 2%. It is a sign of a healthy economy. But when it gets out of whack, it can create problems. Last month, the US Consumer Price Index, a commonly used inflation metric, rose 5% compared to a year ago, more than what the Labor Department was anticipating. Indeed, it is the largest increase since summer 2008. There are a number of reasons why inflation can tick higher. It mostly comes down to economics, demand, and supply. Prices can rise from an increase in demand, or production cost may go up due to drop in supply. Money supply is another reason for increase in inflation. Whenever there is a lot of something, that thing tends to be less valuable, cheaper. Too much money supply devalues the currency, and it costs more to buy things. Since the pandemic, we have seen record low interest rates, several rounds of stimulus to both the consumer and businesses, and pent-up reopening demand across different industries. All of this has led to demand outpacing supply, causing shortages and price spikes, may it be food items, housing, semiconductor chips, used cars, oil, and lots of other things.
So really the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there.
Mr. Powell and his team is tasked to keep this economy a well-oiled machine. They do this by maximizing employment, keeping prices stable, think inflation, and managing interest rates. Their long-term target for inflation is 2%. And when it goes out of control, you will often hear Fed making monetary moves. Here are some examples. Increasing interest rates make it more expensive to borrow money, so people spend less, reducing demand. As demand drops, so do the prices. Increasing the cash reserve requirement for banks, forcing them to hold more money in reserves. Banks lend less to businesses and consumer, which leads to drop in demand, drop in prices. Finally, reducing the money supply. One way to do this is by making government bonds more attractive. When people buy bonds, money goes back to the government, reducing the supply. Less supply equals less spending, which means prices stay in check. It's funny how it works. Let's investigate the latest CPI numbers. We can see notable moves in food, energy, including gasoline and electricity, cars and trucks, used and new, medical services, and transportation services, including airlines. It means you can expect to pay more for cars and trucks, furniture, airline fares, hotels, and everyday essentials like groceries and gas. Housing and remodeling supplies is also on a rise. While things are getting expensive, my paycheck is the same. Sad story, but true. Bottom line, money is not going as far as it once did. Just FYI for all you savers. It is great that you're saving, but leaving money in the bank is a bad idea. Of course, you should have some emergency dough, but anything over that, not cool. Interest you're making is a joke, and inflation can make your cash worth even less. Remember, inflation reduces the value of money. If you did nothing and just dropped your money in some S&P 500 ETF like SPY, you will make way more money. Get invested. Typically, stocks is considered a hedge against inflation in the long run, meaning the money invested in stocks maintain its value during the inflationary period. Businesses over time adapt to inflationary pressures and eventually profit margins come back. In the short term though, things can get ugly for a few reasons: falling revenue and margins, economic slowdown, and higher interest rates. Also, the overall value of stocks get questioned. As inflation goes up, present value of future cash flows fall. The value of $100 that company is expected to make 5 years from now may be worth $80, $75 or less as inflation ticks higher. For this reason, you will see growth stocks come under pressure since their earnings are much farther out in the future. Here is the formula to estimate the present value of future cash flows. I, in this case, is the discount rate. Higher inflation-adjusted discount rate diminishes the present value of future cash flows. This in turn lowers the current stock price. Google the dividend discount model for more information. Here is what you need to know. Typically, value stocks outperform growth stocks in the short term during periods of high inflation. And we've seen this already in 2021, where value outperformed growth in anticipation of inflation. Over the long term, things will even out as growth companies adapt to inflationary pressures. Basically, stay put and do what you do. Invest consistently. By the way, there is a link in the description if you want to track my portfolio. Stay invested. You want to invest for inflation, meaning ensuring that your rate of return outpaces the inflation rate. By not investing gets you nowhere. As I said earlier, by just investing in SPY will give returns much better than inflation. If you really want to play it safe, think bonds. The interest payment for TIPS or Treasury Inflation Protected Security rises with inflation, meaning interest payments are inflation adjusted. Personally, I'm not a fan of bonds. Invest in physical assets which has intrinsic value like real estate and gold. Or maybe Bitcoin. I know it is getting killed these days, but that only means you can get Bitcoin at a low price.
The high interest rate that we're seeing today is the start of something that could be as bad as the 70s.
You say higher interest rates or higher inflation?
Inflation, I'm sorry.
Yeah, very, very unlikely. What we're seeing now, we believe, is inflation in particular categories of goods and services that are being directly affected by this unique historical event that none of us has lived through before, called reopening the economy after closing it. So you see extremely strong demand for labor, for goods, for services, and you see the supply side caught a little bit flat-footed and trying to catch up. And you see bottlenecks and you see this all over the world, by the way. This is not just the United States. You see it everywhere, and it's very similar kinds of situations. And you have a central bank that's committed to price stability and has defined what price stability is and is strongly prepared to use its tools to keep us around 2% inflation. So all of those things suggest to me that an episode like what we saw in the 1970s, and I graduated from college in 1975. I had a front row seat. That nothing like that. I don't expect anything like that to happen.
Here's the bottom line. Inflation means cost and prices are rising. When they do, it means that money buys less. Mr. Paul agrees inflation will probably remain high in the coming months as economic recovery continues, but expects inflation to drop to 2.1% next year and to 2.2% in 2023. The easiest way to manage inflation is stay invested. As a long-term investor, treat this buzzword as noise. Thanks for watching. Until next time, peace.